Well, it's a good morning from him, and it's a good morning from me. Welcome, everybody. Hope you're well. Welcome to my live stream. I love that synchronizing the music, don't you? A bit of fun, isn't it? And the other bit of fun, of course, we've had today, I don't know if you've noticed, but the first time in like 10 days, yes, 10 days, we've actually got sunshine out there. Can you believe anything as weird as that? Which is crazy when you think about it. We had 10 days without any sun at all, which is just like completely crazy. Anyway, enough of that. Let's get on with our live stream today. Hoping all is good with you and you're well and you enjoyed the interest rate cut recently. Things are getting busier, particularly in the specialist market, in the specialist finance marketplace, you know, bridging, seconds, that sort of thing, development finance. I know a lot of brokers and companies in that space, as we call it. Sounds like a universe, doesn't it? But we use that phrase, don't we, in financial services. You're in this space or that space, you know. Anyway, they're getting really busy. Lots of business going on. Interest rates getting more competitive now, of course, as the economy starts to move a little bit in the right direction. But we'll wait and see. We've had years like this before. It's not unusual, is it, when it comes to it? Got a couple of tips and ideas for you later on with my session on becoming or bringing back good vibes. Got that coming out later for you. But I've got a couple of CMAP updates for you in technical sessions, which I'd like to share with you for your CPD and for your general learning events as we go through. So without any further ado, let's go on air, shall we? And get ourselves over to our first whiteboard, which is over here. Here we go. Onto the whiteboard for our first session today, shall we? Let's get going with Consumer Credit Acts. Consumer Credit Act is my first heading for you. So let's get talking about Consumer Credit Act, shall we? Here we are, Consumer Credit. There we go. Consumer Credit Acts. Now, I used the plural sense quite deliberately because there has been a number of Consumer Credit Acts over the years. And if we take a look at a timeline, so let's just put a timeline up here for you then. Here you go. We love a timeline, don't we? Which indicates the period of time. Now I'm going to go right back to 1974, the first act in 1974. Here we go. 1974 Consumer Credit Act, which, you know, it's a long time ago, but we had credit back then. My mum and dad used to have what was called HP, or hire purchase, and my gran had a catalogue which was also interest added as well. And people started in the 1960s started getting a lot more credit than ever before, because in the 50s and 40s nobody had credit, did they? Because of that, they decided to regulate it. Now, they regulated it on loans less than £25,000. Now, 25k back in 1974 was a lot of money. That's what footballers got transferred for back in those days. So anyway, it was there to regulate small loans effectively as well. It was loans, credit cards. You had a few credit cards then, not a huge amount you got now. HP was the big one, of course, and other types of credit as well. And it regulated advertising of consumer credit. It regulated the agreements that people took out. It created the cooling off notice, which we all love and know about, where the client has the time to change their mind afterwards. But it also brought in the key thing called the APR for the first time, the annual percentage rate. We now call it the annual percentage rate of charge. That came in a couple of years ago, APRC. And the APR was revolutionary in a way, because up until that point, anybody could charge, well, whatever rate of interest they wanted, but they could express it in any way they wanted. And they could add fees on top and all sorts of things. It's very difficult to compare interest rates. APR brought in the ability to compare. So if you had an interest rate from a hire purchase and you had an interest rate from a credit card, both had to display the annual percentage rate, which included all of the compulsory charges and how the rate was applied. So, for example, credit cards are usually applied monthly, aren't they? At a couple of percent, which sounds rather low, doesn't it? But if you annualize that over a year, you're looking at 30-odd%. So you can now start to compare different rates of interest quite easily as well. So that was 1974, long time ago, of course. Why is it still in the book? I don't know, but they always add to these things, don't they? In 2006, we had our next act. Let's put 2006 in there for you. 2006, we had another Consumer Credit Act that kind of updated things really and modernised things. First of all, they got rid of the 25 grand mark as well. So it was any type of loans, credit cards, those sort of things were covered by the Act itself, which made sense. They also included FOS. not a comedian from a 1950s based American TV show. FOS was the Financial Ombudsman Service, which of course deals with complaints and things like that. They added that to the arena as well, which made it a lot easier. They expanded the coverage of different types of loans that were brought in as well. And they brought in unfair contracts as well. So if something was unfair, terms and conditions, you were able to override it. Other than that, it pretty much added to the 1974 one as well. Now, the big change, of course, was in 2014. I say, of course, that's a bit naughty, really, isn't it? Because you may not know that. But in 2014, which itself was 11 years ago, it wasn't a new act, but the Financial Conduct Authority started to regulate the consumer credit. They took over from the OFT. So the FCA, if you like, took over from the Office of Fair Trading to regulate consumer credit. That's pretty much what happened in 2014. And they created what's called the CONC rules. I love that, don't you? The CONC rules. It stands for Consumer Credit Rules. They could have got a better acronym than that one, couldn't they? Pretty much, it allowed the FCA to enforce the previous Consumer Credit Acts as well, and tighten things up and organise things. I mean, the CONC rules themselves, we've got a separate video on that one, but they themselves actually cover quite a lot of new ground when it comes to regulating consumer credit as well. It looked at financial promotions, of course, brought them in line with regulated. Well, by the way, this stuff didn't cover mortgages. I bet you get that, though, didn't you? This was just consumer credit. It wasn't mortgages. Let's put that in there in a big, not mortgages. I think that's key to know that, isn't it? There you go. But obviously this one didn't, but the FCA already regulated mortgages up until that point. So it looked after financial promotions and the CONC rules and how they're sold as well. It also brought in the senior management and certification regime to regulate, authorise the people. They had to fall under the conduct rules. Those people that got involved in giving advice on consumer credit got into it. A couple of things then happened. In 2015, they started to clamp down on payday lending, or they called it payday lending. There you go. But it's a collective term for stupidly high interest rate, cheap lending that was given to anybody with a pulse. And back then you had a number of firms, they've all gone bust now, and Amigo loans and all sorts of things going on, where it was, hundreds of percent for people, legal, totally legal, wasn't, knock on the back door kind of stuff. But they started to authorise and regulate and keep an eye on those people, and as a result of it, they trimmed down the rates they could offer. And I think most of them have all gone bust now, which is a good thing in a way, but it takes it underground. People will always need to borrow money, and if they can't, they'll borrow it from somewhere. The other one that you need to be aware of that's filtering its way through from this change is the car loan scandal. Now, you might have read about the car loan scandal. There you go. Now, you appreciate car loans are a form of consumer credit. That's what they are. They're just loans on security of a motor car that are often underwritten by the motor traders, the dealers, the manufacturers, and obviously the big banks. And although they were regulated and authorised, there wasn't a lot of oversight going on. The FCA said you've got to do this, but there wasn't a lot of checking going on. And what was happening is that these car loans were being sold by the dealers, by the car salesperson, who probably wasn't very well trained on this kind of stuff, and hence caused a few issues, particularly with the commissions that were being paid. And that's the issue here. Back then, they weren't disclosing the commission that they were earning from selling the insurance. And as you know, you have to do that, don't you? You have to disclose the commissions and the fees. We've been doing that for years, but they hadn't done that. Then they had the issue around making the interest rate higher to pay them more commission, which is a bit naughty on everyone's back, isn't it? But that came through. But now it's all going through to the courts, and it could well be the biggest mis-selling PPI type claim money back thing going on the next few years. So that's something you might be aware of as well. Other than that, that's the CONC rules, Consumer Credit Act, done in a few minutes. I hope you enjoyed that. Bye. There you go. Lovely. Nice update there for you on that topic of Consumer Credit Act. It does make you think about 1974. I mean, I got my first credit card when I was 18. I think that was 1981, I think 82, I was 18. I got my first credit card. I worked in a building society, so I understood interest rates because I was learning about those things. We had mortgages and savings rates, but most people had no idea about interest rates and what they meant or did. So these sort of things are all good, aren't they? Let's go on to another topic, shall we? And let's go to our same whiteboard, because I can and I will do. Let's give this a good rub out, shall we? For those of you watching it. Hope you're all good. Hope you're enjoying your work, keeping yourself up to date with all things, thinking about your goals for the year, thinking about where your business is going to take you. It's all very exciting, isn't it? Coming into spring and all those good things. Now, let's take a look at another topic for you, which is very close to my heart, actually, and I'll explain to you why. This one's training and competence. So let's put in T and C, shall we? Training and competence. Now, training and competence, again, it's in the exams, you need to be aware of this, often abbreviated for T and C. You might have heard of the T and C officer, who you might have in your firm if you're working for a company at this stage. Now, T and C was pretty much brought in to stop the mis-selling of financial advice. And it was brought in a long time ago now. It's brought in 1994. And I was working at the time at Black Horse, and it had a massive implications to our force. We had 280 financial advisors at the time, which we were trying as training manager there, and we were training them up. And it basically meant that you had to start training people properly and getting exams and things. Before that, there was none of that going on at all. It was up to the individual companies what they did. And it changed everything. Suddenly, people had to be educated and had to pass exams in order to become authorised. And it was a great thing. I worked for Black Horse, which had massive training anyway, because big banks did back then. Anyway, how does it work then? Well, first of all, you have what's called a time frame. So let's put a time frame in there between starting or recruitment. So when you get recruited, you start and then you continue your career in that particular company. It's very firm specific, this as well. Now, you can get yourself into a firm as a trainee, as it's often called. I mean, we call it trainee. There's this period called direct. Here, let's put it in there, direct supervision. Now, for a period of up to 48 months, it seems a long time, maximum 48 months, you can remain a trainee in direct supervision. This means that you're not authorised to give advice. You haven't got your advice ability yet. Somebody's watching you, overseeing you, and keeping you, making sure you're doing things correct, and training you pretty much, but they're taking responsibility for any advice that you want to give to clients until you reach what they call the CAS, or the competent advisor status. And that's when you're given the green light to go off and give advice on your own. And then you enter this thing called indirect supervision. Let's put that in there for you. Indirect supervision. In other words, you are a fully fledged financial advisor, but somebody obviously supervising you, but you can now take the advice risk. So how do you get to CAS then under a T&C scheme? Now remember, this is very firm specific. Every company has their own T&C scheme, which has to obviously be approved by the FCA. There's no hard and fast rules. Now, you've got to reach what they call competence. We call it training and competence for a reason, because you have to reach competence status to get your advice badge, if you like. So what is competence then? Well, competence, I think, is made up of three things. It's made up of knowledge, what you know in your head, although we've got ChatGPT to know all that nowadays, haven't we? So what do you know? Knowledge, your skills in talking, communicating, building empathy, that sort of thing. And the third one I should say, is attitude or ethics. Those two come together, don't they? What kind of character attitude do you have? And what ethics do you carry in your body? Those three things make up competence. And that's what you have to be trained on. So there's a number of key things you get involved in. Let's get different colours going on, shall we? The first one is you need to have the knowledge to do the job. There you go. Now, if you're a taxi driver in London, you know about the knowledge, don't you? But in financial services, you have to have knowledge. Now, this includes regulatory aspects, the products your firm gets involved in, the systems that your firm uses, the computer systems, the software, the rules that you follow in your company, FCA rules, lots and lots of knowledge. And don't forget, of course, the exams as well. You've got to have regulatory exams, which are relevant to the permission that you're carrying out. Now, in CMAT 1, we look at financial advisors, what they call CF30 advisors. So you need a level 4 exam from the CII or the LIBF. Obviously, for mortgage brokers like you guys, you need the CMAP or the CF equivalent over at the CII. But whatever permission you're doing, equity release, long-term care, wealth management, you've got to have different exams for different permissions. And they, of course, can take a long time, which is why you have a 48-month period. You also need skills. You need to develop your skills, which is often an area that firms miss out on. They kind of assume people can do the job, and they don't tend to train people so much as maybe they should do. These are skills in being able to give advice, advisory skills, communication skills, fact-finding skills, building empathy with client skills, emotional intelligence. Even more important nowadays, because your knowledge, if you like, is done by the AI. Let's put that in there for you. A lot of knowledge is going to be used by AI, and we're going to be supplementing our brains through AI as we move forward. That didn't work very well, that green, did it? Let's put that properly there for you. So that's great, and we can't stop that. AI is not going to take over your job. It's the advisors that use AI properly that will take over your job. So be aware of that. So you do need to be able to use AI. Don't replace your knowledge because it supplements it, but then you need to have really good skills to be able to do the job and do the job properly. Now, this all builds a ladder, if you like. So you join the firm and you aim towards CAS. So let's just draw a little ladder here for you. Here's the ladder. You step up, if you like, through various training initiatives, on the job training, lots of observations, lots of coaching, lots of feedback, until you reach the stage where you've hit the competency levels, you've hit the standards the firm wants you to get to, and that's when you get ticked off, if you like. You have various tests and things to indicate you've achieved the right level of competence. That can take quite a while, as we've said there before. Now, once you've got your CAS, which can be quick if you've experienced, but if you're brand new, it can be slow, then you've got to maintain your competence. That's the whole point. The firm has to make sure you are maintaining your competence. So what the firm does is it puts a great big magnifying glass over you. There you go. There's my magnifying glass. You like that one, do you? And they call that oversight. You might have read that phrase before. The FCA use that one. In other words, they need to make sure that you are maintaining your competence by giving you oversight, by having a supervisor that watches over you all the time. Not continuously, that would be a bit big brotherly, wouldn't it? But a lot of firms now use computer systems which keep an eye on what you do, because they do. A lot of networks, they require that you start the client journey from the system, and you enter into the system every aspect of the client journey. So the system feeds information back to the company as to how you're doing, how you're performing. So that's one way that which they do oversight as well. There's a number of other key areas for you. They have to observe you and assess you on a regular basis. Observe and assess. Now, a lot of firms use role plays. A lot of firms have somebody go out on a client meeting with you, and they watch you and they tick off a little checklist to make sure that you're doing the job properly, both compliantly and with good skills as well. They will often review your advice that you're giving. Now, your advice, of course, is on a system, on a computer. So somebody will go into the computer system and access the client details that you've had and check you made sure you give them the right advice. You know, is the fact find properly completed? Is the suitability report completed correctly? Again, computers often do this automatically now. With AI now, it's saving a lot of time, but humans will still be involved in that process as well. There'll be a manager or a coach, somebody like that, looking for training gaps, maybe. Where are your gaps in training? So, for example, if you've been an advisor for a few years now, you probably need training on AI and how AI can help you give better financial advice to your clients. So that's an area, that's a training gap that's being revealed. They're going to look at KPIs, or key performance indicators. KPIs are data stats which tell me how well you're doing or how well you're not doing. So they'll be constantly monitoring those as well. And if they're clever, they'll be giving you lots of annual testing to do, lots of tests periodically to make sure that you're maintaining your knowledge and abilities. And I do that with a number of networks. We do a lot of training and tests and things to make sure that the network members are keeping up to speed. Now, with financial advisors, there's one more thing you need to be aware of. This doesn't affect mortgage brokers so much, mortgage advisors, and that's the the CPD type of thing. Now, what a financial advisor has to do each year, she has to apply for what she calls her statement of professional standing. Let's put that in there for you. A statement of professional, there you go, standing. Lovely phrase. Or the SPS, because we love an acronym, don't we? So let's put that up. So she has to apply for this statement of professional standing on an annual basis. She has to get hold of it, of course, with CAS, and then she has to renew it each year. Now, to get her SPS renewed, she has to submit, or the firm submits, a declaration to the educational body in which she did her exams with. So if it's with the LIBF or the CII, she has to submit it through them. And they will want to make sure that she's got her CPD record up to speed. Now, CPD, continued professional development, is something that financial advisors have to do. And they have to do a minimum of 35 hours of CPD. And 21 of those are what they call structured CPD. So proper courses are being well thought through, objectives, that sort of thing, not just reading the paper. So there's quite a lot of CPD they have to do. Not a big deal if you're professional, of course, because you're going to be doing that, aren't you? They also look at your ethics. They do a regular inventory on your ethics, because they're really important things. I mean, all good financial advisors should be ethical anyway, but they make sure that you are as well. And they take a look at your conduct. Have you had any complaints or any problems giving business advice, that sort of thing. And then you get your SPS. It's kind of like an annual certification. Mortgage advisors don't need to do it, by the way. If you're a protection advisor, you have to do 15 hours of CPD, but that's another regulation that brings that one in as well. So that's training and competence. Some firms are really, really good at this. Some firms are very poor at it too, which is up to them what they decide to do. Depends how risky their business is. But it takes time, it takes money, it takes people to do this, which is why when you become a mortgage advisor and you pass your exams, many think they can just go and become an advisor. It's easy, give me a job, somebody. But to give you a job, they've got to get you to this CAS period. They've got to take you there. And to take you there costs money. It's a bit like the driving test, isn't it? The driving theory test is the knowledge exam, but the actual driving around in town is the skills, the observations, and that takes time and money, which is why they're reticent to take lots and lots of people on, because there's a huge investment on the firm's part to get you to CAS. And then, of course, you've then got to stay with them for quite a few years to pay it back, if you like. So if you ask for a fee, if you join a network and they ask you for some money up front to pay for this, don't be surprised, because they're just covering their costs. That's training and competence. Created in 1994. What a long... That was the year with Blur's Parklife was released, wasn't it? The seminal album from Blur, Parklife. Google it if you've never heard of it. I'm sure you have on your Spotify anyway. Hope that's been useful. Bye. Brilliant. Okay, so we're doing okay, aren't we, with this? So a couple of updates there for you on some key topic areas for you. What I want to do now is finish off with a kind of a skill section, as always. We do a little work on skills for you, don't we? Now, this one I called How to Get a Good Internal Vibe. Love that phrase, don't you? How to get a good internal vibe anytime you want one. Now, we all need to feel good on the inside, don't we? Sometimes we wake up feeling positive, but more often than not, we wake up with a low vibe inside. Now, here's how you can change that vibe in seconds. Now, I've always enjoyed having some money in my pocket, never more so when I was 16. You see, I wanted to go out, I wanted to meet people and have a good time. Now, these were the days before social media, before mobile phones, before the internet. And the only way you could meet people was to have money in your pocket and head out to the clubs and the pubs. Now, at age 16, I had a problem. I didn't have much money. Admittedly, I had a job marking up newspapers at the local newsagents in the mornings, but this only gave me enough cash for my bus fare to school, sixth form, my comics that I always used to buy, and my music albums, which I loved. Now, I needed some more cash. And I had a brainwave one afternoon whilst cutting my dad's grass at home. Why don't I mow other people's lawns for hard cash? So I started borrowing my dad's lawnmower without him knowing, wheeling it up the road to the garage to fill it up with fuel, and then dragging it to the terrace houses at the top of town, which had those communal lawns out on the front. A quick knock on the door, and I was able to collect £1 each. And with £10 in my pocket, I'd perfectly cut the lawn outside. An hour later, I was £10 richer. Now, word spread to the other houses, and soon enough I was earning 25 to 30 pounds just for a few hours' work. Less the petrol costs, of course, and I had 30 quid to go out that night and have a good time. Good times. I felt independent, I felt excited, and I felt very proud of myself. Now, it's a pretty good feeling, isn't it, to have as a teenager? And it's even better to have as an adult facing all sorts of pressures and stresses at work. But here's the thing, the psychology, the secret here, smells take you right back to the moment, back to the memory, and they allow you to relive that good feeling that you had at the time. Smells, you see, have no cognitive barrier to the memory. They have no filter. They just take you straight back to the memory of the smell. Now, the two smells that take me back to those good times in 1980 and live the good vibes of independence and excitement and pride are unleaded petrol and fresh grass, freshly cut grass. Now, it's a simple technique then, but it works wonders. Every time I need a boost of good internal vibes, I simply smell the smell. Now, it's quick and easy way to transport me back to those days of independence and excitement. But what about you? What about, are there any smiles or smells, I should say, that take you back to those good memories? Perhaps it's the scent of a loved one's perfume, the familiar aroma of sun cream on a beach day, or the comforting smell of bacon from a childhood camping trip. These are universal triggers that can transport you back to a time of joy and contentment. Now, before you start asking why a 16-year-old would get into pubs, this was before identity checks. I kind of looked older for my age back then, which is great when you're 16, but not so good when you pass 60. There you go. I hope you enjoyed that one. Just an update there for you, a little kind of resilience sort of saying, really, isn't it? Okay, we're going to wrap up as always. But as always, let's get you onto our mailing system if you're not there already. So let me just put the QR code up for you so you can see that. There you are. Scare me in, as they say. So let's just pop across out of the way there. We've got a few things coming up. We've got our DIP FA starting in 1st of April, which I'm looking forward to. Getting more and more financial advisors now coming in, more and more mortgage advisors wanting to become financial advisors. And we've got a DIP FA cohort starting on the 1st of April. More information available on our mailing system. And that's what this Advisor Development Hub does. It gets you onto our database and we keep you informed. We call it a member hub as well. So make sure you get on there if you're not. Other than that, have a fantastic week, everybody. Enjoy yourselves. Enjoy your week ahead of you. Enjoy what the world brings. A bit more sunshine, hopefully. And I'll see you again next week.